This has been a virtually unprecedented momentum-driven market. Not principally, but mostly. So you mentioned that the return was 25% in a year where earnings were up 8%. So the market went up triple what earnings did. It's interesting that at the end of 2023, the consensus among the top-down strategists was that we were going to finish 2024 at 4,900. They were basically saying the stock market's going to go up with earnings. We blew through 4,900 in the first quarter of last year. And then everybody is chasing the market and everybody's adjusting their numbers higher because they can't fall behind. And even though the earnings fundamentals that were expected didn't change, the price of the market changed. And you had a 4-point multiple expansion in the S&P 500. So that's how you explain this market. It's animal spirits, which means there's a lot of psychology. To be an economist or financial market pundit, you have to be a lot of things. And you have to be not just a historian, but also a psychologist. Animal spirits was the term coined by John Maynard Keynes, and it didn't apply to the economy. The economy is not the stock market. GDP is not a listed stock. Animal spirits refers to the extreme emotions of fear and greed. Maximum fear in March of 2009, maximum fear in March of 2020, and now we have maximum greed. So we got the data from the Census Bureau. It's called the American Time Usage Survey. And I wrote a psychological report on the American household. How are we spending our time differently post-COVID? What happened was during COVID was the government gave us a pile of dough and we had nothing to do. We became day traders. Did you notice that Reddit, Robinhood, all this stuff, all this momentum day trading by young people happened after COVID? I go into an Uber and I'm on the phone. When I get off, the Uber driver is talking to me about the markets. About the stock market, everything you said was correct. It is very concentrated. Over about 42% is in technology and telecom, which is the exact same concentration in the market we had back in March of 2000. We are in a price bubble because I look at the CAPE, the Shiller cyclically adjusted price earnings multiple that goes back to the 1920s at 37. We've only been this high before in 1929, 1999, and for a brief period at the end of 2021. And neither of those years were followed by a very good outcome. Now, they say valuations aren't a timing tool, and I agree with that, but valuations at any point in time represents whether you have the wind at your back or the wind in your face. But you see, and everybody always thinks they'll be able to time the exit, and inevitably they don't. When we have a 2 standard deviation event, right now it's 2.3. There's no other stock market in the world, by the way, including Canada. No stock market in the world has its CAPE multiple anywhere close to where the US is. Only the S&P 500. So price bubbles can last a couple of years. You know, you could argue that this thing really got going at the end of 2022 with ChatGPT, and now we're in early 2025. So time could be running out, but nobody can ever time when a bubble is going to pop. But we have to ask ourselves the question, why is Warren Buffett sitting on 30% cash in his 60 years? He's never done that. What is he seeing? The classic value investor. But he's seeing what's happened in terms of the valuations. Price is what you pay, and then the value of your future cash flow stream is what you get. But then again, cash is paying you close to 4.5%. Might look back at the end of this year thinking 4.5% was a home run. There are years where that happens, but nobody expects it right now. And when we looked at actually the data, we looked at what are the returns over the 1 year, 3 year, 5 year, 10 year return in the S&P 500 when the CAPE is where it is today. And in no time period is your future return positive. In every time period, you're better off being in cash. So that's the deck of cards that we have right now. I do intend on becoming bullish at the first opportunity, but the valuations are going to have to improve markedly. And that's where I stand on that. Momentum markets, I tend to avoid those. I'm more of an old school fundamentalist. I would respect the market. The multiple was already quite high going into 2024. And then we had the market triple what the earnings did. If I told you that earnings are going to go up 8%, would you say, oh, the market's going to go up 25%? And the starting point is like a 17, 18 multiple. It's not like it's 12 or 13, but that's what happened. What I find fascinating is I will readily admit that we've had a shift in the technology curve, that this generative AI is a serious deal and it is a game changer. There's some people that believe it's as big as the internet. I'm not quite there, but there's been a shift and investors have lengthened their time horizons. So we went and looked at the past 100 years worth of data to see, firstly, what is the normalized 5-year earnings growth projection embedded in the stock market at any moment in time. And that number is 8%. At the time of ChatGPT, it was about 10%. That's the 5-year expected annualized growth rate in earnings per share. Where is it now? Over 20%. about triple the historical norm. The market is already telling you. See, that's why I think a lot of this is already priced in. The last time that we had 20% earnings growth priced in for 5 years was back in the late 1990s. So these are great companies, make no mistake. It's just the stocks that are just too much priced in. If you believe that we're going to get 30% earnings growth, well, for you, the market's cheap. But I'm not so certain that we're going to get 20%. They call it the dot-com bubble. It wasn't a dot-com bubble. It wasn't all about pets.com. You had companies, they all got caught up in the same mania. Microsoft, Intel, Cisco, IBM, Dell, they all got caught up. And they all collapsed. Those stocks were down 60 to 80%, and then it took them a decade to get out of the penalty box. And when I hear about that, there was no business models in these dot-coms. And it wasn't just a dot-com rally. We called it TMT. I was at Merrill Canada back then, technology, media, telecom. And these were companies at the time that had cash flows, they had business models, they had real profits, just like these companies do today. And that's always the comeback to my view. Well, the companies today, they have real business models. NVIDIA, they have real earnings. I get it. I just don't believe they're very good stocks. And my money is with Warren Buffett on this one. Some of the cheapest markets in the world, for example, are in emerging Asia. But, as Don Cox famously said, emerging markets are markets that you can't emerge from in an emergency. And of course, China is a big part of the emerging market world, and they're going to get hit with a tariff, and they're dealing with the ongoing aftershocks of bursting of their property and debt bubble, question marks around China. But you have some of these countries have single-digit price earnings multiples. You're salivating as an investor, but then you start thinking, as you're going back and forth, do I put money in emerging markets? But maybe they're cheap for a reason. Okay, then you go to Europe, same thing. The European market, dirt cheap. You have all this political instability, especially in Germany, France, the UK. UK is a very cheap stock market, very attractive, but you've got fiscal problems. The problems over there are much worse than they are in Canada. Their inflation is more sticky. Canada does not have sticky inflation. And Canada doesn't have really a massive fiscal problem. We talk about it a lot. There's a big household debt problem in Canada. Europe is cheap, but maybe once again, like emerging Asia, maybe it's cheap for a reason. Canada's trading at a 15 forward price earnings multiple. When you look at the Cape, we're trading bang in lines, very strong neutral. We're not anywhere close to 2.3 standard deviations. We're just closer to the norm. US is trading at a 22 forward multiple, we're at 15, 7 multiple point gap. It's almost unprecedented. It's like Canada's for sale. When something goes on sale, you don't normally want to buy it. Not just that, look at the bond yields that the TSX is competing against. The bond yield in Canada is 3.25%. In the United States, it's 4.6. The US market is competing with a 4.6% 10-year Treasury note yield. What has happened in the US, which is truly ridiculous, is you have an equity risk premium of 0. It means that you're not getting paid as an equity investor to take on equity risk. The stock market in the United States is telling you that equities have become a riskless asset class. Think about that for a second. Equity investors are putting the S&P 500 on the same risk characteristic as Treasury bills. How do you feel about that? I know how I feel about that. When you have the equity risk premium at 0, the market's telling you this collection of 500 stocks, it's not totally 500, are basically collectively 0 beta. Last time this happened, late 90s. But I know that I'm not going to chase nickels, dimes, and quarters in front of the steamroller right now. The train has left the station. So in Canada, quite a bit of difference because the equity risk premium in Canada is 3%. The stock market is paying you to take on that risk. In the United States, the market is not paying you to take on that risk. Not just that, the dividend yield in the S&P 500, do you know what it is? 1.2%. Does that get you excited? Doesn't get me excited. I like dividends. Cash flow. And Canadian, the TSX dividend yield, 3.2%. That sounds enticing to me. And so when I take a look at what's going to happen in Canada, which was already happening before the tariffs come, it'll reinforce it. Much lower rates with your Canadian dollar. The tariffs come, you got to avoid the stuff getting hit by the tariffs, which is industrials, consumer goods, basic materials. But there's going to be a lot of stuff. Like, what tariff is Trump going to put on the banks? He's not putting tariffs on services. He's putting them on goods. So you want to own the stuff that's going to do well with lower rates and a steeper yield curve. Financials, REITs, utilities, telecom services, and the weaker Canadian dollar is going to be a boon for travel and tourism. All the stuff I'm talking about right now that's going to benefit from lower rates and a weaker dollar accounts for 50% of the TSX. The stuff that's going to get hit by the tariffs, that's 30% of the TSX. So people will be surprised that even though this is going to be horrible for the economy, it won't be nearly as horrible for the stock market, and especially if you're in the right sectors. So I wrote this report at the beginning of the year that said, the title was Attention US Investors, Leave New York and Come to Toronto. Because don't forget, the added kicker for them is they're getting the Canadian dollar. Even if we go to 160, we're going to be closer to the lows than we are to the peak. We were last at that level in 2002, around the SARS shock, if you remember, and the bank was cutting rates without the Fed. We didn't stay at 62 cents indefinitely. So Americans get to pick up a much cheaper market with a much better yield and a much cheaper currency. And I tell this because 70% of my clients are in the States, and I want them to stay out of trouble, and I want them to make money in a prudent way. Despite all the warts, scars, and pimples, Canada's really looked this good for a stock market perspective relative to the US than is the case today. I am a long-term bull on gold, absolutely, and precious metals in general. Why? Because the first thing you brought up, you talked about uncertainty. The word uncertainty showed up 12 times in the latest FOMC minutes. It showed up 6 times in the beige book. We are uncertain, and gold is an effective hedge. There's other attributes against uncertainty. The world's always uncertain, but we're in a different level right now. Like, you want to talk about standard deviations of benchmarked against the norm. We are way above that. So gold is a good hedge against instability. And with all the political instability, what's Trump going to do and not do? And it can go either way. Gold is going to offer up that diversification, bastion of stability in a portfolio in an uncertain world. I think that makes perfect sense. So the answer is yes, I'm still very bullish on bullion.